What's up, investing legends? Today we welcome Jonathan Tuttle to the program. Jonathan is the COO of Land, a flex office space development fund focused on capitalizing on the undersupply of flex office space in certain markets around the country. Jonathan is extremely well known in the mobile home park investment community and gained lots of recognition online for his contributions to the mobile home park investment community. And in this episode, we break down some of the reasons why Jonathan has decided to pivot from mobile home park investing into flex space development. We also talk about some of the differing philosophies that Jonathan brings to the table versus the old school mentality of stick to one thing and stick to it for 40, 50 years versus Jonathan's more opportunistic type of investment strategy. We get into some of the market fundamentals and the demand drivers that are causing a shift away from mobile home parks and why Jonathan is super bullish on flex industrial and data centers in 2025 and beyond. Jonathan's opportunistic approach is very new school. You don't see a lot of old school operators switching from one niche to another to take advantage of the market trends and the conditions, but it's very obvious to me based on our conversation that Jonathan has a new school mentality that allows him the flexibility to pivot and take advantage of market conditions when opportunities present themselves. Very fascinating conversation with Jonathan. So without further ado, everyone, let's welcome to the program, Jonathan Tuttle.
Welcome to the Investing Secrets Podcast.
Jonathan, welcome to the Investing Secrets Podcast.
I'm excited to be here.
Yeah, man. Show. You ready? You ready to step inside the vault with me?
I am ready. Third time's the charm.
Third time's the charm. Yeah.
For people's contacts on me in the background, Airbnb cleaning in the background. It was a little distracting. So.
We're sealing the vault. No one can come in.
Yeah, so nobody gets to see that. But like, if you got to see the live version, it's pretty fun.
Oh man. So, well, hey, I'm excited to chat. You know, we were talking a little bit offline before, and I understand that you have kind of like pivoted your focus, right? And Land Play is your new development company. So tell me a little bit more about the strategies that you're deploying right now, and then we'll get into the why, right? Love to understand the strategies.
Sure, yeah. So my background mainly has been mobile home parks and commercial estate brokerage. Been in this space since 2005, seeing like how it's went from like a novelty, little-known secret, marketing would say, till now it's pretty mainstream asset class. Mm-hmm. And as you know, if you talk to other mobile park brokers or even the people in the space for a while, the deals few and far between nowadays. And what I've noticed is a lot of the other operators in the space have added a secondary asset class, self-storage, industrial, some parking lots, some multifamily. I wanted to go with the industrial because I thought if you look at the green sheet data, people familiar with institutional data, it said that industrial, self-storage, mobile home parks have been three of the top performing assets for the last 8 years, and is very similar. So what we do is flex space, which for people aren't familiar with it, best way to describe it is basically a combination of both. 90% warehouse, 10% office, usually in smaller footprints. Now, don't think of like a big national distribution plant. Think of like your local HVAC plumber that wants a footprint with good like retail like location, but also visibility from the signage, but also has a little bit of office. That way they get two locations in one, basically. So they have to like commute, they have an office here and that location here with the extra trucks or wherever else you have that business.
That's awesome. So flex space is kind of like the new asset class that you're focused on. Now, are you looking at existing flex spaces or you're developing, this is ground up development, flex space?
Correct.
Okay.
Yeah. So our strategy, kind of give people context, we're focused on Texas market, 8 out of 10 fastest growing counties in America in Texas. We're one of the first or second fastest, Oklahoma County, which we're building right on I-35 in New Braunfels. It's basically, just think of it, it kind of comes like a Lego kit. And so that's the best way to describe it. So it's not like some tedious development. Like for example, and we're focused on our strategy multifold, but we're focusing on counties approved within 3 to 4 months instead of like 1 or 2 years. So we want fast that approval. And we also want markets where there's demand for it. And then also the cool thing about it, it's basically, it takes about a month to build because it comes prefabricated metal. You just put it up, you just assemble it over about a month, and then you could have it all leased out, fully developed over like 6 months. And so you could do a whole development within a year time frame that could be a pretty significant footprint. And we also focus on, another thing we focus on, the 12,000 square feet and under, because the national rule to actually have sprinkler system is 12,000 feet. So if you could build smaller footprint buildings, like just under 12,000 square feet, then we don't have to have a sprinkler system. And people aren't familiar with that. The sprinkler system, it's not necessarily a sprinkler system cost to build it in the unit or in the building, because it could be 30, 40, 50,000. That's not the big cost. It's actually some cities will charge $300,000, $200,000 to tap into the water main for a 6-inch hole to have access to the water. So if we can stay underneath that, find high growth markets, and it's fast turnaround development in a market that needs it, it makes sense for us. That's what we're looking for.
That's really interesting. Yeah. So how does one identify, right? Like when looking at flex industrial, what are the data points or the resources that you're using to identify areas that are in need of flex space? Because obviously, like, you're not going to go into an area where there's no demand, right? So
Correct.
how do you quantify from a data perspective areas where flex space is going to be in need?
First we do a market analysis. We use CoStar. We look at the data. We call the local brokers. We see the comps, 116 above per foot. But like, for example, our new brothels, there's 3 others that are completely full, and they're very low quality compared, not low quality, but like average quality, like not tall. They're not even 18-foot ceiling heights. One of them doesn't have, 2 of them don't even have HVAC. Or actually, all 3 of them don't have HVAC. One of them has like big trash in the ground, and they're all like, there's a waiting list. And we talk to the broker. We see what the CoStar data, which is like, like the MLS for commercial real estate.
Yep.
We see that, okay, there's a shortage of flex space in the market. And remember, because the advantage of flex space, it's a very fast product to put out there. And so it's turnaround time. You can work with a leasing broker. Like, our signs are already up in I-35 before we start the development. He's getting calls. And so we already know what we'll need for the next place, the next location, because of the calls coming in from getting that data from the signs right now and the listing broker working it. But basically, it's a very fast, trendy play. So we're just trying to stay ahead of the trend and be ahead of the market and get it leased out, basically.
Mm-hmm. I see. So you're using a combination of boots on the ground, real-time information from brokers, plus data that you're getting from CoStar
to the market. Yeah.
To identify. I see. Okay. And
for example,
and
there's go for it.
Go for it.
1.5 million people moving into new brothels. And so there's 10,000 homes being built across the street from us, and the 3,500 square foot commercial development. Well, if there's 10,000 homes, there's going to be need for HVAC and plumbers that want to have a location right there across the street. So
I see. Okay. And so HVAC, plumbers, what other businesses would leverage or utilize flex space?
Yeah. So doggy daycares, my partner has one that has a big doggy daycare center.
Nice.
People want, and that's actually really good. He just let them run around and put some cameras up and some toys, and it's like high margin business. For example, there's in New Braunfels, there's the world's largest bingo manufacturer, and they have like a little flex space. So it's just basically any business that wants. And another trend you're also seeing too is that some people use it. This is like some affluent person, but they'll have like a car garage, or they just have like a man cave. Sometimes you see that, or they have like, you do see that too, surprisingly. So people have a couple of Ferraris, Lambos, and they have a couch, and like, because the wife's like, no, I don't want them in the basement. So they do the flex space and they put their business in there. Whatever e-com store they have, that's the little office or their job ship or whatever they're doing.
Yeah, that's interesting, man. That's interesting. Yeah, I know, like, there's the CrossFit gym that I go to is
CrossFit
run out of a flex space too. Yeah, so that's interesting, man. The other thing we were talking about too before we got on was office conversions to data centers.
Yep.
And that's also a part of your new strategy. So tell me more about that.
Sure. Yeah. So the long term, we see the flex space 2 or 3 year run, because then there's not crazy barriers to entry to get in. It's not like mobile home parks, for example. There's only 43,000 plus parks, zoning stipulation. Flex space is a lot more free to get, developed, basically. And so to create a moat for the business, we also want to look at another new trend. And obviously AI, everyone's using AI, everyone's on their phone, the data's usage is the highest ever been. We're looking, and we know Mark Zuckerberg, we've mentioned this before, but Zuckerberg was building a data center the size of Manhattan, basically. It's gigantic. And we don't want to be in that niche because that's the big money, the Googles, the Metas. We're looking for this long-term play. We're partner up probably for a couple family offices, but buildings that basically you see these buildings are going for pennies on the dollar, these office buildings that the cities want the tax revenue. And we know, going back to AI, not only that, there's also the disruption of people working different abroad or different locations. And so these buildings a lot of times are just kind of being vacant or very low occupancy. We come in, our plan is to scoop them up, make sure they have enough power, heights, ceiling heights, and we convert them into like a niche, data center basically. And so we're partnering up, and it's such a new niche. There's only a handful of people because it's just becoming a new thing, obviously.
Yeah.
But so we're going to partner up with some people that actually have done that space too, just to get the correct team. It's all about building the team.
Yeah, definitely. Well, and I definitely understand kind of like the market drivers or the demand drivers for data centers, right? We've got AI. I don't know how much cryptocurrency uses data centers,
it
but
does. They use it outside the US though, because the cost of electricity is cheaper.
Gotcha.
Typically.
Yes. So, and obviously like those things are both on like a meteoric rise. And so can definitely see how data centers would be a very practical investment and just from like a principal preservation standpoint, right? Like, hey, am I going to lose money on this? Probably not, right? If it's done correctly. And then also from like a growth trajectory, like, you see, especially now in the early stages where there's a lack of data centers, being able to charge premiums and make a healthy return. So the other thing worth mentioning right now, or we're talking about, and I don't know how privy you are to all this, but I just had a cost segregation expert on the show, and they were talking about how data centers are actually one of the highest cost seg or like depreciation.
Oh, I didn't know that yet. Yeah. Who was the gentleman you did? Or was it
KBKG? His name is John Potsia. He was on the program. Yeah. And
nice.
he very, very interesting kind of like take on it. So yeah, man, really cool stuff. It's like, you've got all of these reasons to invest from like a market demand standpoint, and you get like extra tax benefits. So now these offices that you're converting into data centers, right? Like, one of the biggest hurdles or one of the biggest drawbacks that I've heard from office conversions to say like, well, my background's in hotels, right? So office to hotel or office to multi is like, the infrastructure is so different, and like you've got to rip down all these walls, and basically it'd be cheaper to build something ground up than to just like repurpose an office building. Why is that not the case with office conversion to data center?
Yeah, I mean, so I'm not too versed in the office data center because we haven't done a deal yet. So I don't know if I could quote. That's our next play. So I don't want to give something that it's not versed, obviously, in the flex and the mobile parts, but we haven't done it yet. So we're still basically right now what we're doing in that regard is we're interviewing people to partner up with, and then partnering up with some equity partners with the family office side. So, but yeah, I don't know the exact intricacies of it because I haven't done a deal yet. So I don't want to give any. That's our 5 or 10 year play. But we're looking right now. Actually, my partner is actually doing the boots on the ground, Alec. But I've been doing all strictly focused on the flex space.
Gotcha. Okay. Very cool, man. Well, it's interesting because like, obviously I'm always curious about like what the next thing is, right? Like when someone comes on,
it's going to be data centers. It is going to be just, if you look at like how much, ChatGPT, like it's just the beginning scratching. If like people start playing around with it and see how powerful, like the first time AI came out, I was like, oh, this isn't that great. ChatGPT is like, it was okay. I was like, whatever. Now I'm like, literally my life, like I'll take a photo, like, what should I do, ChatGPT? I literally ask it everything now. It's like crazy. Like even like, for example, when I was booking the Airbnb, I'll take a screenshot of like the map of like 3 different places, and I'll say, what would be the best for me based on my likes? And it knows because it keeps adding more. Like here's a local gem, here's some good restaurants, safe neighborhood, and everything. And so like, and literally, it's like, choose this one. I'm like, that's so crazy. But just all that data, it takes a lot of resources, and it's only going to go exponentially higher. And there's a huge shortage right now. I think it's, I don't know if you've seen that guy. He goes around interviewing everyone. School of Hard Knocks, I think it is. It's
Yeah,
big viral guy.
The
Did you see the
billionaire.
one about data centers he did?
No, I didn't.
So they had that one guy that's he's a big YouTube guy. He's kind of like nonchalant. He's like a typical commercial real estate owner. He's like a nonchalant guy, but he also shares his life on YouTube. And he's like, oh, I just bought this hotel for 16. I'm going to do this, and exit out. He's like real like old school, like how you deal with like the 67-year-old like real estate guys, just straight to the point. But he's on YouTube and people love it because he's like so authentic about it and everyone else not fake about it. Yeah. And he was like, he's a big real estate investor in Florida. I don't know. He's done like some pretty big, like.
Is it Ben Mala?
Yes. Yeah. Ben Mala.
Yeah.
I can't think of his name.
Yeah.
Yes. You know what I'm talking about. But he's like, what's the real estate trend? The guy asked, what's the real estate trend that people should know about that nobody really talks about? And he's like, data centers. You know how he talks? Data centers are like, sure. If you're rich, if you're really, really rich, you invest in data centers. Yeah. So. Yeah, when I saw that, I'm like, I gotta use that for our rankings.
Yeah, exactly. That's interesting, man. It's definitely very, very
learning
interesting.
because it's such a new niche. Like it's literally we're having to add people to the team. We're literally interviewing people to that's their core specialty. So
yeah, that makes sense. I mean, just from just looking at it holistically. I mean, I think that it makes a lot of sense. And then the office to data center also seems to make a lot of sense if the numbers work.
We're trying to navigate the easiest, less headache. That's where you look for going back to flex space, 3 months, 4 months approvals. We've learned our lessons through the real estate over time because one of my partners had, which we're bringing to market, the next deal is 100,000 square foot retail / office, medical office. And it took him 5.5 years to get approvals.
Really?
Which is crazy. So we only go for the quick markets or the counties that want to work business owners and entrepreneurs. So
yeah, makes sense. Wow. I hesitate to ask which county that was in, but I think that's, I'm sure that was in
it's in Hutto, Texas.
Yeah. Okay. Interesting. Cool. So, one thing that I, this has just been kind of percolating in my head. You came from this world of mobile home parks and you were very successful with that. You've been on stages, you've talked. I mean, you've really, you created a brand for yourself in that niche and then you let it all go and you've pivoted now. So I want to walk me through the reasoning behind all of that.
Well, I'm still involved in the space. We still have parks. We're still looking to acquire, but it's, just for people of context, there's about 43,000 and change mobile home parks. That's a great question, by the way. 43,000 plus change mobile home parks. 25% you don't even want to buy. They're what the trailer, that term, that's 25%, late turnaround, nothing of value. And then you have a percentage, since 2015, we know private equity, Apollo, Blackstone, all the big operators are coming into space. You can't even beat them on deals because they have access to capital way cheaper and they don't have to make money for the first couple of years. So, it's just become, if you, I just mentioned before, I spoke at IMN Nashville, Manufactured Housing East. It's a conference, a speaker moderator in the mobile home park space. But you could even see in the people, the other operators are at multiple asset classes. I mean, I've talked to a guy that has 8,000. He hasn't even bought a park the last 2 years. He has 8,000 pads the last right now. And he's been buying self-storage and looking at other asset classes. The deals, the market was from 2010 to 20 was the golden years for mobile home parks. If you were applying then, that was the time to buy. There was a lot less competition. They were undervalued. They're cheaper. They were mom and pop majority owned for 80% at that time, 85%. And so they were under market rents. You could literally come in, put in a website, beautify the front end, raise the rents, and still ethically raise the rents. I mean, the first park we bought, the rents were $125 a month. And the local apartment's $800. So obviously you could raise up to $250, $300. And we turned around during the last recession, 2008, when everything was going down in value. We made money by raising the rents, the equity going up just by raising the rents because it was so much cheaper. And we were having people with houses that wanted to move in that lost their house because everyone was losing their house without raising subprime mortgages. And so you're getting really good quality tenants. You have people that normally were paying $1,000 a month for their house. Now they would gladly pay $300 less. And so, but it goes back, long story short, it's the reason I'm pivoting, like I still will look at deals. I mean, the last deal we put an offer in, for example, there's a bigger park by a major university, and the owner was off market. I was working with the broker. They only wanted 3 offers. There's a family developed it from ground up. The dad or husband or family members died away or passed away. And then the kids, there's like 3 kids, wanted to parcel off and have their nice exit, basically. They want to run it or anything like that. And they're like, so we had to submit a bio and sorry, that was weird.
Good. That was a little, so I was like, what is that? Yeah.
Yeah. It's so weird. So submit a bio and then also verify you have the funds to do it. Cause it was going to be a 500 plus units, significant deal. And so I had one of the investors, my network. He's like, I'll put the money down, and they're like, oh, how much does he have? So he sent his, hit 30 million in cash. I'm like, how do you have 30 million in cash, dude? He was like 35. He was a young kid too. It was like younger for that much. And then they're like, oh, we like it. You have the personal background and you have enough cash. But long story short, the other 2 bidders were private equity. And they just basically, we lost a bid. And so it's like, it's what's happening a lot. You basically, in this, because the owners now have gone their years. It's not like before where like there's a lot more brokers in the space too. So the broker, they're telling them, hey, this is what it's worth. So you're not going to be able to, like, that person was like thinking becoming, that investor is like, oh, I heard you could kind of scoop them off market for like a price. I'm like, everyone knows the value, because even if they don't even ask for broker opinion value, they're getting like 3 things a week in the mail and phone calls every day. Hey, will you sell your park? I'll give you this. So they know approximately what the park's value is. And you can't get those deals anymore. And so, and then like also it becomes like a lot of the deals you find are like, you're basically building a subdivision. So like there's so much, vacancy, you have to fill it. And so that's what kind of like, I was like, wait, what's highest returns real estate is always development. So I was like, I grew up and my dad was a real estate developer contractor. He built 75 custom homes. And so I always had that side of the family. I remember as a kid, I'd work on the job sites. I'd fill the dumpsters up.
Oh yeah.
So, yeah.
That's what you just said there with the 3 people calling them a week with the letters and stuff. 43,000, it's actually like, that's nothing. So,
exactly.
You've got all these investors and all these groups now who found out about this niche, and now they're all going after 43,000, right? You've got
exactly.
So, I mean, that makes sense, right? It makes sense how these parks are now, and contrary to that, or in contrast, you've got on the residential sector, you've got millions, hundreds of millions of homes, right?
Exactly.
Around the US. And then, with multifamily and all these other asset classes, there's more pie, right, to slice up. So I can definitely see how that would become a very inflated or competitive niche really quickly. Because everyone's been talking about mobile homes for so long.
Exactly. So what made it good is also what made it the moat. Warren Buffett always says invest in the moat, not scarce in supplies, scarce inventory. So when you have it and you can't really develop new ones, it's very hard to get approval. That's the main beauty about it. But then at the same time, when everyone else is competing for the same thing and there's not much new inventory, now you're just making it really competitive for you to get scale. Basically, it's really hard to scale nowadays, the park industry, and that's why all the operators are doing other asset classes. And another thing too, the deals are a lot smaller. Like for example, if you look at the average mobile home park, a few million, 5, 10 million, it's very rare to get like over a $20 million mobile home park. They're out there obviously, but there's a very small and like amount of inventory like that. And for comparatively a $20 million mobile home park is like a $70 million multifamily in terms of deal size and like how rare it is. And so just the fact that there's just not a lot of big deals too makes it even harder. So if you do get big investors, and for example, if people, family offices, they haven't really come into the space. It's probably the least asset class they probably invested into. They all love multifamily, but because they're big deals. And then like, they'll ask, like, I'll get family office, like, oh, we're thinking about getting into the space, but we need this, this, and this. And the criteria is like, that doesn't fit.
Right.
You can't make it. There's no like, very few $50 million parks, and or they want another thing that you don't see a lot. So you don't see a lot of family office invest in space. A lot of them will say, hey, the fund needs to be 50 million or 100 million. and which is easy with a multifamily, buy a couple big
apartment buildings,
multifamily, and you're there. But to find the amount of deals to do that, so you're not going to, it's very few inventory, and then the size of the deal. And so that's what makes all these like challenges that people wouldn't normally see unless you're in the space.
Yeah, fascinating. I didn't really think about deal size and raising from institutions or family offices, but that I could definitely see. I understand now, just kind of walking through that with you. You're probably limited in terms of investor pool by the size of those deals, right? And it's hard because it's like 20, or 10. It's hard to raise retail capital for like a $10 million.
Exactly. You're underneath the threshold. They're under that threshold. Some will say literally whether we only do 50 million, or because family office will put in a few million. They don't want to be a large percentage of it on top of it either. So like, it's just that weird oddities. So you got to there is family office that do, but it's like few and far between comparatively to any other asset class. They're just like, it makes it more challenging. And yeah, if you look at like, it's just fascinating because I was at that conference and like, it's even the size of the conference has gone down from the last 2 years. Everyone's like, man, each year it's like, because they'd be looking at other asset classes for that reason, because it's just, like I literally talked to like 3 different operators, like how many you get? Oh, you got nothing in the last year. We're maybe doing one this year. So one park acquisition, I should say.
I think that's a sign though. I mean, look, there's 2 contrasting investment strategies, I guess you could say, right? That I've seen be successful, right? So I've seen 2 different approaches. The first is like, I'm going to pick my niche and I'm going to stay in my lane. And for the next 50 years, this is what I'm doing.
Yeah, the old school.
Exactly. And then,
like
100%. And, like that's great. And there's a lot of older school people and even, people nowadays that like, this is our niche and this is what we focus on. But then there's the opportunists, right? So the strategy that you're kind of like, that you're talking about right now is more opportunistic, where it's like, hey, we see where the trends are heading and we are going to pivot. Right. The hard part, or the thing that I think is that adds like a degree of difficulty, is when you shift into a new sector, there are things about that sector that you don't know. And so you have to then become very educated very quickly and learn all the things about that in order to be as successful as possible. Because, obviously you're not going to get into something, you shouldn't get into something that you don't know anything about. Right. So that, kind of talk to me about, Jonathan, like I'd like to hear, when you decided to make that pivot into Flex Industrial, what was that learning curve like? And how did you kind of like get into it and accelerate that learning curve so that you could like get into it confidently and start executing on a business plan? Sure.
Yeah. Well, it comes down to team. So partnering with a seasoned team, like one of my partners, Harry's full cycled $100 million in the local market. So that's why we got a lot of these like really good off-market deal flow, because everyone knows who he is. He actually flipped property adjacent to 160 acres across from Tesla Gigafactory. And so he's really got roots in the ground for a long time, full cycling in that local market. My partner, Alex, he's done a few flex space. That's been his niche for the last like 3 or 4 years. So like literally having people that are like, my whole core focus with this is I do help with the capital raising. I help with the marketing, like Google ads, podcast interviews. I speak on stage, a lot of different major stages, even in other niches, but it still brings people into us. And so basically having a team where everyone bring the pieces together. Beauty about the flex space, it's not a lot of like complexities compared to other asset class, because it's a shell, some concrete. It's coming prefabricated. Yeah. It goes up in a month. It's 90% open and 10% like, oh, we want to dust here and throw in some HVAC. We're doing it like I guess the best way to describe it is kind of like self-storage, basically, with a little office, but for businesses. So it's not like, which is very similar to, mobile home parks. A lot of mobile home park operators do self-storage. So just basically it comes down to having the right team, everyone's core focus on what their high level skill set, and just, immersing yourself in the industry. But overall, it's a lot less complexities, like significantly less than mobile home parks. Because mobile home parks, you had the sewage systems, you had the zoning issues, you had the tenants, like you're dealing with you're not dealing with, business owners, you're dealing with people that, low affordable housing. So just all those factors, flex space is significantly easier asset class for sure.
The lower overhead, right? Or like just the lower, it seems like a lower cost to entry, right?
Yeah.
Overall into this sector, which could be a good thing. It could also be like a bad thing, right? So play devil's advocate here.
Sure.
Couldn't we also say that because the costs are lower and everything, like what's stopping like 5 other groups from coming in and putting flex space right next to you, right?
Yeah.
And then like now you've got 5x the competition, because it sounds like from what I'm hearing, not only are these things cheaper to put up, but they're also probably don't take that much time to put up either, right? Especially if you're bypassing like the sprinkler thing and the whole thing, right? So like, I could also see an argument for that there. So what are you doing to kind of hedge against that, if anything?
Sure. So we're focusing on fast, high growth markets and prime real estate, like I-35 property. We bought it. Well, long story short, we bought it with our relationships off market. We could literally flip it for a $1.7 million profit just on land, because all the growth coming in with now it's all verified. So high growth markets where the prime piece of real estate still comes back down to who has the best real estate, and it's still undersupplied. And remember, since it's so fast, we don't that's why our long-term play is data centers, because we don't think this will be, 3 to 5 years from now, it's going to be, like you mentioned, it's going to be a lot more people doing it. A lot of people are sort of figured out, but being ahead of the curve, it's like 2010 to 2020, it was time to buy a mobile home park. It's time to buy self-storage. Right now, for the next 2 years, is the time to do flex space. And that's why the long-term vision, that's why I mentioned, alluded to the fact of data centers, because in 3 years, they'll still be rented out because with our primest real estate and the primest location. And we're also bringing in premium products like our market. None of the other ones have HVAC. We're bringing in HVAC. And if you're in Texas and anybody's been in Texas and know how hot it gets, you want to have HVAC in there, little things like that. And being on the prime frontage for this visual, there's 120,000 vehicles per day in front of our location now. But they're spending, the state of Illinois or state of Texas is spending $3.5 billion into widen the road. So all that adds a lot of value, because how many cars, I don't know how many vehicles per day, but probably be 150 at that point. So it's a 2 or 3 year run. So that's the beauty of it, the speed, the fastness of it. You take that to your advantage, and also understand we're not going to be doing even our next project is going to be more, like I said, retail with office conversion. So it's not strictly flex space. We're looking where the market needs what product it needs. But in 2 years from now, if somebody's listening to this podcast, it's like the money is going to be made. We're going to make the money, but the people that do it now will make the money. It's just like mobile home parks in 2010. That's where the money was made.
So to make sure that I'm understanding the strategy correctly, because so it sounds like what you're doing. So it's ground up development. Are you leasing it up then and then doing a sell off? Is that the plan?
Yep, exactly.
You're going to lease it up.
100%.
Gotcha. Yep. So this is not a super long, what's the hold on this?
24-month exit. Yep.
Okay. So
all your rejection, that's how we do it. We maximize the value. We got to be ahead of the trend, maximize value, you're out, and everyone wins.
And then you're selling it up. Right. So you're taking advantage of the trends because you built it
all together.
You lease it up, and then everyone, oh yes, I need flex space, or I want to own flex space because this is a great profitable.
Sell it to the owner.
And then you get to understood. So you've insulated yourself from that because you're the first mover in the area. So no matter what, yours will be the first building. And then once you lease it up, you sell it off, boom, done.
Yeah. And we're a premium product. So we're the only one out there, and we're prime best location. So having all that together, it's just a quick in and out, and everyone wins.
Yeah. I like it. I like it a lot. So I want to pivot a little bit here, Jonathan, because, you talked on previous podcasts about capital raising. So I understand that your focus, and just kind of based off this conversation too, it sounds like you do have some institutional, like family office type connections and relationships, but as a percentage, right? Like typically, what percentage are you bringing in institutional capital? We'll loop family offices into that too, even though maybe not super, but we'll loop that into that category versus like retail investors. Like what's the split there? Is it 100% institutional, no retail, 50-50, 70? Like what does that look like?
Sure. Great question. So our typical investor is surprisingly other real estate funds, but not funds of funds, but like other fund managers with their own capital, not like the fund capital. So like there's a lot going back to what I was saying, like people like the team, they like the deal, they love location and like fast exit. And so our typical, like most of them have like pretty significant, they have a multifamily investor, a couple of multifamily investors, like another person is a part. So there's like people that are already in real estate that are, they wouldn't be considered like institutional. I guess it'd be institutional. I mean, but they're usually like funds, but we don't have any family office in this round yet. Reach out to everyone. I do reach out to them because I go to like the different conferences. I've got two that are saying that like what we're doing, but they said they've already done their allocations for this year. You know, a lot of times pro tips, a lot of times the first quarter is the best time to be in, like build a relationship long term with family office because it does take a long time to build a relationship with them. But a lot of times most of their allocations be first quarter. And so we have two that like the deal, but they're most likely might do one of our next deals. But right now it's big, like I would say, I call them like sophisticated, mid-tier, like underneath institutional poly, but they're mostly fund managers, real estate, like big investors.
The way that you're structuring these deals, and it sounds like you're doing like purely syndication model for all these assets. There's no fund. Did you ever raise a fund for the mobile home parks, or were those all syndicated as well?
Yeah, syndication. We tried to do a fund, and then it was during COVID, and then so we shut it down. It's like even the paperwork. I was supposed to speak at the big conference in Vegas with Dr. Ben Carson, who was the former Secretary of Urban Housing and Urban Development. That conference got all the conferences. And so we're like, we're just going to shut this down and wait till COVID gets over. And then like, it was just bad timing. Like it was just like the worst time to raise capital. So like, go for it. I was like, we're just going to do syndications. And the value to feedback we also got too, like just doing this for a while is the syndication. Like we could literally cherry pick the best deals. Like this deal right now, we're giving like the most favorable towards investors, like 80-20 split, 12 pref, 22 projected plus IRR. That's very conservative IRR. And so we could give the best terms instead of trying to find deals, kind of go back, because I learned from the park side, it was like trying to find enough deals to fill the fund up. This we get one great asset and give the most favorable terms and do it by deal. And so like the feedback, and that's why the fund managers have been really receptive. So like, hey, you're literally picking the best deal. And that's what made us attractive. And for them, they're like, it's a quick turnaround, 24 month, this is great for a lot because they have capital sitting there on the sideline right now. So basically, that's, it's just identifying the best, look at 20 deals to find the one deal. And that way we could literally, for the investor's sake, we're getting the best possible asset from that one deal. And so, it is more work than raising a large amount of capital, but the beauty is that the size of the deals, we have enough in the pipeline that eventually we do a fund. But like, I think right now, the feedback from our investors, they prefer that syndication model.
Yeah. And it provides ultimate flexibility because the thing about a fund is, there are limitations, right? Based on whatever you kind of define as your investment thesis or box in the PPM. Like there's going to be deals that come up that you're like, man, I wish we could do this. Right. Yeah. And one thing that I've seen solve for that before is some of the groups that I've worked with, they have like a co-GP fund. So basically they raise retail capital into their fund they use that fund to basically satisfy the GP contribution into a project. Okay. And they'll do a JV with like a family office or institutional partner that brings in, 80% of the equity. The GP fund will bring in 20% of the equity. Right. And then there, for the retail investors that are investing into that, it's a great deal for them because GP economics tend to be a lot more lucrative than LP economics. Yeah. So the retail investors are actually making more by investing into that kind of vehicle. And then it also provides more flexibility for the GP to kind of go out and like pick projects and then just partner with JV, institutional capital on a one-off deal basis. So they're still syndicating every deal, but they have a fund that they can basically use to like, it accelerates their ability or allows them to do more deals because they're not relying on their own capital to seed the GP portion of the equity, right? And a lot of these groups, they want to see the GP bring in 10 to 20%, right? total equity contribution. So if you can kind of get around that, quote unquote, around that by raising a fund like that, it's a really cool like hybrid model that it's very interesting to me. Could work really, really well. Jonathan, this has been awesome, man. We're running low on time. And, but before I let you go, want you to leave the audience with one final, we'll call it like a golden secret. Take it away.
All right. So yeah, it's been great being on here. Took a couple takes. People didn't have to hear that, luckily. that
stays in the that stays in the cutting room.
The background. That was hilarious. But I think the biggest thing is like I always like look at how Warren Buffett invests. Like kind of like just I think you learn from some of the best, and he's also very involved in mobile home parks. He's the biggest financier and also the biggest new home builder with Clayton Homes. He always says create a moat around your business, and so look for trends, get ahead of the trends, create a moat around your business. And so I think what we're doing right now, we're seeing ahead of the trends, we're creating a moat. We've been in real estate long enough that we could like identify great opportunities and move quick and have the right team and have the right execution. And so just having all those pieces makes it real estate a lot easier. I guess that'd be the best way. So like going back to the beginning of the conversation, like, yeah, parts are still great, but there's not a lot of inventory. You can't scale it. Flex space is great, but it's going to be short term. What's the next thing? Data centers. So always trying to find the next trends, find the opportunities, and build the team accordingly.
Love it, man. Jonathan, this has been great. Appreciate your time, and thanks for hopping in the vault with me.
I appreciate it, man. It was a fun podcast. Thank you.